Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Shelley. Alan, on January 6th, I sold a July 5250 call option for $2.90 on WFC, a stock already in my account. Now the premium is $3.60 and share price moved up to $54.38. I do not want to sell my stock. When should I buy back the option, and is it possible for the premium price to go down again? Well, Shelley, absolutely. We could talk about avoiding your shares being sold early, and also whether or not that premium can move back down again. Let's first start by reviewing Shelley's trade. Okay. Shelley at some point purchased 100 shares of WFC. Of course, I don't know if it was 100 shares because it wasn't implicit in the question, and we don't know when those shares were purchased, but they were purchased prior to the sale of the option. They were already in Shelley's account. The 5250 July call was sold for $2.90, and about a month later, on February 7th, WFC was trading at $54.38, well above the strike price of $52.50. Now, the cost to close his position was $3.60, and the question then becomes, when do I buy back that option? When should I close that short position to avoid the sale of those shares, which Shelley does not want to sell? And the second part of the question was, is it possible for the premium price to go back down again? All right, to kind of make some sense of this, let's have a look at the options chain at the time that I received Shelley's email, and let's have a look so we can evaluate this trade from a couple of different perspectives. Okay, you could see from this options chain here that Shelley, to buy back that option, would cost him $3.60. That's in the ask column in the middle of the screenshot. To the left of that, the bid column shows $3.50. That's the amount of cash that would be generated if the option holder, not us, but the person that bought that option, sells the option. So the option holder could sell the option for $3.50. That's the published bid. And Shelley, or the option seller, can buy it back at $3.60. All right, so now what we're going to do is let's look at this trade through the eyes of the option buyer, the option holder, to see whether or not we should worry about our shares being sold early at this point in time. So what if the option holder does in fact exercise the option, which is what Shelley is concerned about? Well, the shares are going to be purchased from us at the strike price of $52.50. They could be then sold at market at the current market value of $54.38, thereby generating a profit of $1.88 per share, or $188 for every contract that Shelley had sold. All right, now that's one possibility. But what if the option holder, instead of exercising that option, simply sells the option? Well, you saw from the options chain that the option holder can generate $3.50. That was the published bid. So $350 versus $188. In other words, the option holder can generate an additional $162 profit by selling the option over exercising it. The reason for that is that when you exercise, you capture intrinsic value only. You lose out on the time value component of the option premium. Therefore, Shelley, at this point in time, there is very little chance of early exercise at this point in time. Now, a possible exception to this would be when there is an ex-dividend date prior to expiration of the contract, But when you're 6 months away from expiration, that is still highly unlikely. As you get closer to contract expiration, then the dividend, if there is one in this case, becomes more of a factor. All right, so there you have it. There's very, very little chance of early exercise because of the fact that the option holder will lose out on the time value component of the premium. So let's summarize here. First of all, you should know your exit plan prior to entering a trade. In this case, Shelley, you knew that you did not want your shares sold. So you kind of have to treat this a little bit differently than if it just was a non-issue for you. Early exercise is extremely rare, especially when expiration is 6 months away and there's such a large time value component to that option premium, because early exercise will in fact result in loss of that time value if the option holder does exercise early. Ex-dividend dates could be a factor, but usually it's closer to expiration of a contract than 6 months away from a contract. So even now, unless the option holder knows very little about dividends, ex-dividend dates, time value components of option premiums, there's very, very little chance of early exercise, even related to an ex-dividend date. Now, let me just briefly address the second part of your question, which was, is it possible for the premium to go back down in value? And the answer is absolutely yes. There are a few different ways that the premium can go down. First of all, it goes down almost automatically from the passage of time. As time passes, the time value component of the premium will get lower and lower. That's in the Greeks known as theta. Secondly, it can decrease if the underlying security has its implied volatility go down. So if it becomes a less volatile stock, the premium itself will also decline in value. That's known as vega. And finally, and most importantly, if the price of the stock goes down, then the value of that option premium will go down as well, and that's known as delta. So there's absolutely a possibility of premium going down. It's actually more likely than not. If the price stays the same, just the time value component alone will go down because of theta and the passage of time. So, Shelley, I want to thank you for asking those questions. They're very relevant, particularly to covered call writers who want to retain their shares. Perhaps you've owned these shares over a long period of time at a low cost basis. Sometimes it's related to a dividend that members want to continue to generate. So for whatever your reason, it's important to know the likelihood of early exercise. In this case, it's very rare. So I want to thank you for asking that very pertinent question. And of course, I want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it, and I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.